Hello, I'm Doug Porter, Chief Economist with BMO Financial Group. So we've seen a lot of economic news over the course of the summer, and that's nowhere more true than here in Canada, where we've heard all kinds of talk that the Canadian economy is potentially in a recession. And that's the issue I'd like to address today. First off, there's no disputing the data. It does look like we are going to get two consecutive quarters of outright declines in Canadian GDP. We already know the first quarter was negative, and the early indications from the second quarter suggest that we also saw a decline in GDP in the second quarter as well. Now, many have jumped on this and said that, well, Canada's in a recession, and that is the sort of the traditional or technical definition of a recession. But the official definition is a broad-based, prolonged, deep decline in the economy, and I simply do not believe that Canada quite meets that standard, at least not yet. And it's especially the broad-based nature that it doesn't meet on that definition, because the decline that we've seen in Canadian GDP really has been concentrated both by industry, mostly in the oil and gas sector, and regionally, most in the prairie provinces. We are not seeing broad-based weakness right across the country. And the other side, besides just looking at GDP, to fully qualify for a recession, you also need broad-based declines in employment, and we're simply not seeing that in Canada. In the first 6 months of the year, the economy actually added about 100,000 net new jobs, and they were all full-time positions. And on top of that, we actually saw, a number of items, especially on the spending side, that simply are not meeting that recession definition. We actually saw record auto sales through the first 6 months of the year. Home sales were very strong almost across the country. If you took out Alberta, home sales actually would have been at a record high in Canada in the first 6 months of the year. So the bottom line is we simply don't believe that we are yet in a recession. Now, we also believe that the economy is likely to show a little bit of growth through the second half of the year, and we've been asked a lot of times why we think, given this pronounced weakness that we saw through the first half of the year, why we're so confident that we think the economy will come back in the second half of the year. There are a few pillars upon which that's based. First of all, we do think that the U.S. recovery will improve further, and that, along with the big decline in the Canadian dollar that we've seen in the past year, will likely give a bit of a boost to exports. Also, one of the biggest negatives in the first half of the year was very, very deep capital spending cuts that we saw right across the energy industry. While that's still going to be a negative through the second half of the year, it won't be as big of a drag. And finally, there were some very specific special factors such as auto plant retoolings, wildfires in Alberta that also hit first quarter growth, and we think that those temporary factors will lift. So we do see the economy returning to growth in the second half of the year. Now, having said all that, we do think this will be one of the slowest growing years for the Canadian economy outside of a recession in the past 50 years. We're only going to see growth of between 1 to 1.5%. In that kind of environment, the Bank of Canada is more likely to cut rates further rather than raise interest rates, and the Canadian dollar will remain on the defensive. We actually see the Canadian dollar weakening to as low as 75 cents as we move through the fall. That's the economic comment for this month. Thank you very much.